Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at 3 artificial intelligence stocks to consider buying on the dip and holding, and none of them are named Nvidia. The 3 stocks we're looking at today are Taiwan Semiconductor, Constellation Energy, and Micron. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast, and make sure to check out our Zacks.com/promo page for a look into some of our services, portfolios, and more. So before we jump into these 3 stocks, these 3 AI stocks to consider buying on the dip, I quickly just want to go over where the market is at the moment. So nothing has really happened to start the week. The market's down slightly, but it's kind of moved sideways. I'm recording this on Thursday morning. So over the last 3.5 trading days, we've kind of just moved sideways after that big rally to all-time highs following the election of Donald Trump for the second term. Wall Street's betting on lower corporate taxes, less red tape, and other efforts that will drive economic and Wall Street growth. And this is everywhere from technology and crypto to infrastructure and beyond. So this is where the market stands at the moment. We could see some near-term profit taking, and it would really hardly be shocking considering the run we went on after the election and the run we've been on for the last year and 2 years off the market's bottom. So thankfully, though, the next dip should be bought up rather quickly, considering that the November January period is also the most bullish stretch for the market historically. But with that in mind, we're going to take a look at 3 stocks that are actually already trading solidly below their all-time highs to consider buying, even though the NASDAQ and the S&P 500 are trading right at their all-time highs. So the first of those 3 stocks, these AI stocks to consider buying on the dip, is Taiwan Semiconductor, which trades in the ticker TSM. It's one of the more straightforward buy and hold tech stocks. The company is the semiconductor manufacturer with Nvidia, Apple, and tons of other tech giants, all depending on Taiwan Semi to physically build the most advanced microchips out there. The cost and institutional know-how required to build these cutting-edge semiconductors creates a really almost an impenetrable moat at this time for Taiwan Semi, and this backdrop is why Taiwan Semi has tripled the Zacks technology sector over the last 20 years. And its growth outlook is pretty impressive since its chips, the chips it builds, help really drive the entire economy, from everything from artificial intelligence chips to chips that are in almost every advanced technology there is, which is what is fueling economic growth in the US and around the world. And one of the bigger things hanging over Taiwan Semi's head that many people point to is geopolitical fears with Taiwan and China and the US. It's addressing some of those fears by expanding its manufacturing footprint outside of Taiwan. So let's dive into a little bit more of the business. So it pioneered the dedicated semiconductor foundry business model that's helped it evolve into one of the most dominant players in the vital industry. The company reportedly earned 61% of the semiconductor foundry market share in the 4th quarter of 2023. Those are the most recent results I could find, blowing away second place Samsung, which was at 14%. It's almost unrivaled on the cutting edge of chip manufacturing, and it's ramping up its industry-leading 3-nanometer technology. As I mentioned up top, some of its clients include Apple, Nvidia, and other tech giants, all of which who count on Taiwan Semi for building their most critical and advanced chips. Shipments of its 3-nanometer chips accounted for 20% of its total wafer revenue in the 3rd quarter of 2024, which was up from 15% in the 2nd quarter of 2024, so a solid jump there. The company also said that advanced technologies, which are defined as 7-nanometer and more advanced, made up 69% of its quarterly wafer revenue in Q3, up from 67%. So it's continuing to ship more of these cutting edge chips. As I said, 3-nanometer chips, which is the most cutting edge at the moment, accounted for 20% of all its wafer revenue, up from 15% in Q2 of 2024. So that's a solid jump there. Overall, its revenue increased 39% in the quarter, with earnings per share up over 50%. The company provided solid guidance once again, driven by AI demand and more. So the company has averaged about 18% sales growth between 2018 and 2022. And then it had a cyclical downturn in 2023 with down 4% in 2023. With that said, the company's projected growth sales by roughly 26% in 2024 and another 24% in 2025 to go from $69 billion in 2023 to $108 billion next year. And its adjusted earnings are projected to grow by 30% in 2024 and then another 28% Next year, it currently lands a Zacks rank number one strong buy given its impressive upward earnings revisions. So since it's over the last several months, its outlook for 2024 is up 4%, and its outlook for 2025 is up another 4% as well. And this is part of a long-term upward revisions over the last year plus for Taiwan Semi. The company also has consistently beaten our bottom line estimates. And as I mentioned just before we get into some performance and technical levels and valuation, expanding its footprint outside of the US, it opened a plant in Japan earlier this year, and it's also investing heavily to build semiconductor factories in the US, fueled by these government incentives. Some people are a little nervous that Trump is talking about the CHIPS Act in a little bit different way, but overall, it seems like the administration is going to focus heavily on reshoring and manufacturing more things in the United States. So it doesn't seem like Taiwan Semi's plan to build these big factories and foundries in the United States would be super derailed, and they've already been kind of delayed over the last few years, just given the big task it is to build these plants when you haven't built them in a long time. It just shows kind of how involved and high tech the business is that Taiwan Semiconductor is running. So now moving on to performance, the stock has more than doubled the tech sector over the last 10 years, while more than tripling the tech sector over the past 2 decades. This includes a 255% climb in the last 5 years, and it finally broke firmly above its previous highs back in May. Its shares are up roughly 83% year to date, yet they're trading around 9% below their mid-October highs and 19% below their average Zacks price target. The stock, as I record this on Thursday afternoon, seems to be finding support right at its 50-day moving average, which is a solid sign, and it's trading below neutral RSI level, so it's already cooled off a bunch. It's currently trading at a 34% discount to its 10-year highs at 22.3 times forward 12-month earnings. That's also a 14% discount to the Zacks tech sector. Meanwhile, we should note that Nvidia trades at 43.5 times forward 12-month earnings, and as I said, in Taiwan Semi is trading at 22.3. So really big discount there. Obviously, the massive growth is not there, but remember that Taiwan Semiconductor is building Nvidia's chips. So overall, it seems like a pretty nice bet on a pure play chip manufacturer that's part of like a backbone of the entire economy. Physically builds those chips that are going to be the bedrock of all technology, from data centers to AI, and it also pays a dividend. And it's worth noting that 8 of the 10 brokerage recommendations that Zacks has are strong buys alongside no sell. So certainly worth considering. Taiwan Semiconductor at the moment, as I mentioned, it's a Zacks rank number one, a strong buy. And before we move on, it's worth noting that in full disclosure, I do own Taiwan Semiconductor in my own personal portfolio. And now we're going to move on to Constellation Energy, which trades in the ticker CEG. It's one of the nuclear energy companies and stocks ready to play a major role in the economy in Wall Street. It's a top 10 performing S&P 500 stock in 2024. It is down significantly from its highs. So let's kind of dive into everything the company does. It's the largest U.S. nuclear power plant operator, boasting 20 reactors at roughly a dozen sites across the Mid-Atlantic, the Midwest, and the Northeast. It helped usher in the AI nuclear power age when it landed its 20-year power purchase agreement with Microsoft in September. The company is currently retrofitting its current power plants to keep them running for longer and reopening decommissioned plants, part of that deal with Microsoft, and venturing into next-gen reactors as well. It's aiming to grow through mergers and acquisitions and return more capital to shareholders via buyback and dividends. The company went on a big run when it announced in early 2024 its plan to boost its dividend per share by 25% in 2024, exceeding its original 10% growth outlook. The U.S. government's also helping provide a price floor for nuclear power to boost the expansion of domestic nuclear power industry. The U.S. government's trying to triple capacity by 2050. The government's kind of gone all in on nuclear energy, as it's now kind of the big future of the energy transition, and Constellation is at the forefront of that. And now nuclear energy and AI kind of going hand in hand, with AI needing so much power to support its growth efforts, that's kind of these two things are going together more than ever before. So if we look to their Q3 results in early November, it grew its adjusted earnings by 29%, topping our estimate, and it expanded its revenue by 7%, surpassing our estimate as well. It closed Q3 with cash and cash equivalents of about 1.8 billion, up from just 368 million at the end of 2023. It also reduced its liabilities and its long-term debt during the period, so that's a good sign. It narrowed its full year 2024 adjusted earnings guidance with its new midpoint marking 64% year-over-year earnings growth. It also, the CEO, Joe Dominguez, at the time, so in the earnings release, really synthesized the long-term case for, near-term and long-term case for Constellation Energy. He said, quote, "The importance of AI and the data center economy to America's economic competitiveness and national security cannot be overstated, and Constellation will do our part to meet the moment. Our customers are looking for clean, emission-free energy that they can rely on in every hour of every day. There's no more important commodity in the world today than clean energy, and that is where you need it." So they see their business kind of being at the forefront of the energy transition and the AI boom for years and years and years to come. And also, once again, at the time, pointed to its visible double-digit long-term earnings per share growth backed by the nuclear production tax credit. So that's, as I said, this is the U.S. government supporting the expansion of the nuclear power industry after years and years of stagnation. The company has fallen significantly recently, so it's still up about 95% year to date and 145% in the past 2 years, but it's trading 20% below its early October highs and 22% below its average Zacks price target. It's trading below its 50-day moving average. It's trying to find some support near its previous highs from May. So we'll see at the moment if it falls all the way down to its 200-day, it could kind of be like a screaming buy opportunity. But if you're a longer-term investor, trading 20% below its highs seems like a solid entry point, and it's currently trading at some of its most oversold RSI levels over the last several years, so worth considering. And then in terms of its valuation, its impressive longer-term earnings growth outlook helps it trade at a 20% discount to its highs and 20% below its Zacks alternative energy industries average with a PEG ratio of 1.5. And now we're going to move on to the last of these three AI stocks not named Nvidia to consider buying on the dip, and that is Micron Technology, which trades the ticker MU. It is a memory chip powerhouse that's outlook is improving. You know, what used to be a very cyclical industry in the cyclical part of the semiconductor industry, Wall Street's now viewing Micron as more of an AI play directly. It predicted that AI will drive record memory chip demand. The stock had been on a big run because it's also been able to be a key supplier for memory chips for Nvidia's artificial intelligence processors. It is one of the largest makers of memory chips in the world, and its offerings are found in everywhere from PCs to smartphones and other devices. And as I said, now it's more of a direct AI play. It's also growing through data centers, connected vehicles, 5G and all that, but now artificial intelligence is kind of swallowing up all of that to be like the growth driver for Micron and lots of the tech industry at the moment. Memory had been historically a very, very cyclical part of an already cyclical business, which is the semiconductor industry. Luckily, it's become more resilient given that it's not just reliant on smartphones, which are a bit of a cyclical business as well. The company said earlier this year that they predict, as I said, kind of up top, that AI will drive record demand for memory chips. The CEO said last quarter that robust AI demand drove strong ramp in its data center products and its industry-leading high bandwidth memory. The firm also is set to build more manufacturing plants here in the United States, which could be a big part of the business going forward, which is a solid sign. Micron topped our Q4 2024 earnings per share estimates in late September, with sales up 93% year over year. It also swung from an adjusted loss of $1.07 per share to positive earnings of $1.18 per share. So that, as I said, shows kind of the cyclicality of Micron's business at the moment. Its earnings revisions have trended slightly in the wrong direction since its release, but they remain well above where they were this time last year. As I mentioned up top, memory chips have become increasingly important components of AI processors. In particular, a form of chip called the high bandwidth memory, HBM, is a necessary component for the latest processors from companies like Nvidia. Micron had kind of been the leading player in that space. That said, Samsung said in its third quarter earnings call that it completed an important phase in qualifying to sell the most advanced form of memory chips called HBM3E to a major customer. So that kind of sparked some nerves that Samsung might be competing directly with Micron to supply some of these key memory components to Nvidia. Overall, though, even with its downward earnings revisions, it's still expected to grow its adjusted earnings by 566% in 2025. So fiscal 2025, it's already in there. So from $1.30 to $8.66, and then grow another 50% next year to $12.55 per share. So just massive growth on the bottom line, both this year and next year. And this is supported by an expected 52% revenue growth to go from $25 billion to about $38 billion, and then another 25% next year to get up to all the way to nearly $48 billion. In the business, as I said, is cyclical. It had done $30 billion in sales in 2018. Then it went to $23 billion, and then it went to $21 billion. And then by 2021, it went all the way back to $28 billion. And it did $30 billion in 2022, and then it fell all the way to $15 billion in its 2023, soared back to $25 billion in its fiscal 2024. So it does show that it's kind of ebbs and flows, but it looks like this next stretch is going to really see it break out to well above all-time highs, where it had done $30 billion in sales before. It's now going to do $38 billion this year and then $48 billion next year. So get way above where it had ever been before in its cyclical business. So that's a good sign for Micron going forward. And as I mentioned, even though its earnings revisions have trended a little bit in the wrong direction recently, its 2025 estimate still up about 60% over last year, and its 2026 estimate is up 235% over the last year. Micron stock is up around 190% in the past 10 years, which lags the tech sector, which is up about 320%. But Micron, if we look over the last 15 years, is up 1,200% versus tech's 620%. It's only up 18% at this point year to date, and it's trading 35% below its summer records and 46% below its average Zacks price target. It's currently trying to find some support at its 50-day moving average. It's hit that a few times recently, and it's fallen back below its 200-day several times as well. And if we look longer term, it's trying to find support at its 50-week moving average, trading below neutral RSI levels on a 10-year time frame. It's also trading at a 60% discount to tech at 10.9 times forward 12-month earnings and near its own 10-year median. So its valuation is solid there as well. And 23 of the 27 brokerage recommendations that Zacks has are strong buys, and it pays a dividend. So certainly worth considering Micron, trading well below 35% below its summer records and 46% below its average Zacks price target. And I said its valuation is marking a 60% discount to the Zacks tech sector at just 10.9 times forward 12-month earnings at its 10-year median, even though it's outpaced its the tech sector by 1,200% up in the last 15 years versus tech's 620%. So might be a time to consider buying Micron on the dip, especially as the broader tech sector and a bunch of these high flyers are trading right at all-time highs. So that does it for this episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.